So anyway, Honorable Leader of the Opposition, certainly the next president of this country in a matter of weeks, Honorable Sajid Premadasa, my esteemed colleagues, Kabir, Iran, ladies and gentlemen. So what happened, see the donkey that Kabir sort of flipped, he had an earlier story also. See, so this donkey actually fell into a abandoned well. And the farmer was wondering now what to do. The donkey was crying. And the farmer felt very bad because all what he tried to do to get the donkey out, he failed. So the farmer said, okay, I'm going to end the misery of this damn donkey. Anyway, I had to close the well. So he started shoveling rubble into the well to end the misery of the donkey. So the donkey cried, farmer was upset, and after a while, he didn't hear the donkey scream anymore. So he looked in. Damn, the donkey was just about coming up the well. Because every shovel full of rubble on the donkey's back, the donkey shook off. And then the donkey stepped on the rubble and the dirt and got out of the well. Now isn't that a better story than a dead donkey? So the moral of the story is perhaps the community here has been subjected to many an abuse in the past, and people say, you know, we came to hear some good news. I just heard a good friend of mine say, look, my portfolio is getting hammered. I hope there is some good news in what you guys have to say. So persistence and sort of intelligence would help us all to get out of this situation we are in. So since Kabir really said everything I was planning to say, bar none, I really don't have much to contribute. So what I'm going to do is to sort of build on a few things that he mentioned. You know, the fundamental is that we, the SJB, believe in the market. We believe in the market. So that's fundamental, right? We don't think there is any Politburo somewhere sitting somewhere in Bastaramulla who knows how to allocate funds. Okay? So that's good news. We think that it is the market that can most efficiently meet the equilibrium in supply and demand. So therefore, we got to get the markets to work. So when people say that there is a mismatch in the supply and demand for capital, it is not because that the market is not the solution. It is certainly the market that is a solution, but the market is inefficient for whatever reason. So therefore, what we ought to do is to create efficiencies in the market so that the allocation of what Kabir was speaking about, of capital between capital surplus and capital deficit players would be matched. Now, Kabir also said that banks were sort of playing the main role in meeting the demand for funds. And that is the truth. Now the issue is that the most efficient way? Should the banking system within the financial market be responsible for funding trade finance, short-term finance, long-term finance, housing finance, development finance? Is it the job of a bank. I recall my days at my first job. I was the chief economist and treasurer of what was called the Development Finance Corporation of Ceylon, DFCC. And one fine day, the World Bank and the ADB stopped the credit lines. When they stopped the credit lines, the market was dry. We were borrowing in the short-term market, in the money market, for 30, 40, 50, 60, 70% overnight, trying to meet the shortfall that the bank had lent long-term at 6%, 5%, 4%. And that is when Mr. Prelis called me to the room and he said, from tomorrow morning, you're the treasurer of this bank. I said, look, there are triple accountants in this bank. Why don't you pick one of those? He said, no, we need to fix the problem, not for them to tell me what the problem was. So anyway, so therefore, the ability of an institution that has short-term funding in deposits, in fixed deposits, demand deposits, for them to be asked to lend long-term is obviously a non-starter. So when you expect the banks to start lending long-term, it won't happen, right? And when people always complain, look, I go to a bank, I can't borrow, he's asking for collateral for my mother's house and all of that. That is because the bank doesn't really have a risk mitigation mechanism to be able to balance that risk. So you can't really blame the bank, right? So the issue really, and also there's a lot of talk about development banking today. Oh, we need to build a new development bank. Okay, let's put up a development bank. 10 stories, nice glass building, hire people, get a CEO, but can you do development banking? No, you can't. You can't do development banking because there are no long-term funds as at right now. So already banks have thousands of branches around the country, and if you had long-term funds, why can't you do development banking? You can, right? So really you got to really figure out where the problem is and then try to find answers. So the ideal situation is the banks. We are talking about the financial market, right? So the banks should focus more on the short end of the market, and capital markets should start focusing more on the longer end of the market. So that is the distinction. That is a separation of responsibilities that an efficient market with short-term funds on the one hand, long-term funds on the other hand, can really play that role, complementing each other. So in that case, when you talk about the capital market, you can talk about the equity market and the debt market. I'm not going to talk about the equity market today because there's a lot that we talk about the equity market. We know it's underperforming. We know it can punch way above its weight class, and we ought to do that. And we got to not mess around like bringing in additional capital gains taxes and things like that. I don't think that's going to, yes, the treasury needs money, but I don't think that's the way to go, because you need to encourage more activity in the capital market, in the equities market. So we need to actually try to see, when we want to develop the capital market, why is the corporate debt market, why is the long-term debt market dead? I mean, if I ask you a question, you all are all the people that run this market, how much of sort of debt do you deal in? I mean, I'm talking not about G6, but on corporate securities. How much of corporate securities do we have? I mean, is there even a market for corporate security, corporate debt? Can I ask you a question? I mean, what is happening to the corporate debt market? Can somebody tell me? Is there one? I mean, is there a corporate debt market in this country? Rajiv? Very small, right? Hardly. But if you look at the world over, I mean, are corporate debt markets much bigger than equity markets? Yes, they are, right, by and large. So then there is this untapped potential in creating a market beyond what we already know on the equities market, and we know sort of risk profiles of our people, whether it be retail investors, whether it be institutional investors, whether it be foreign portfolio investors. But why not look at the greenfield almost? And I'll tell you why we need to do that, because suddenly opportunity has arisen. And that Kabir was talking about. If you look at on one side, you have the capital surplus, and on the other side, you have the capital deficit. So if you look at capital deficit, Kabir spoke about housing, right? Then also spoke about power infrastructure. So there's road, there's rail, there is power. There's all kinds of long-term, long gestation projects that would need debt that would be long-term, right? And then, of course, you can look at hotels, long gestation SME projects that we all know are in trouble. So Kabir also spoke about housing, right? I mean, that housing market, if you really look at how much a young couple can get from the National Savings Bank, right, to build their first house, you will be appalled. I see a lot of young faces here, probably in their late 20s, early 30s, investment advisors, right? I don't want to ask them the question, right? How many of you have been able to start building your first home, right? Isn't that a dream that you had when you got married? Right? Isn't that what the husband and wives thought, sat down and said, darling, let's build a house, buy land, building a house? It has become an impossible dream for our young people. So unless you're fortunate that your parents are able to give you some land, or if you're even more fortunate that they will also give you some money to build a house, right? How many are able to do that? So therefore, he was talking about mortgages, housing mortgages, single-digit interest rates. Okay, so if you can get, like he said, a 20-year mortgage on your first home, and you have tax benefits on your first home, right? Look at what you can do. And by the way, let me sort of say this also, which is not directly relevant to this, and I will come to that because I heard people wanted to know what kind of changes we are going to do to the IMF amendments we are going to do to the IMF program. But on that, there was something called imputed rental tax, which meant that you're living in your only home that you have, and then the government is going to assess a rental income on your home, the home that you're living, and then tax that on your marginal 36% rate. So when Sajid, myself, and Kabir met the IMF, we told Peter to his face, Peter, let's take an example of a person who has a house on 6 purchase, 7 purchase in School Lane, Naval, right? The house is worth X amount of money. It can bring him 150,000 bucks in rent imputed per month, and he also gets 150,000 rupees salary. Just assume, right? So currently you pay 3,500 rupees in income tax. The moment you start imputing that income to your tax, you're paying 35,000 rupees. He said, what? I said, yeah, what? What do you mean? It's 10x. Right? So that kind of silly nonsense shouldn't even be entertained. So let me tell you, even though my leader hasn't sort of sanctioned me to say this, but we said it before it happened. We said we are opposed to this, and so therefore please note, we are not going to tax your home. We are not going to bring an imputed tax and tax that imputed income as income tax, right? So that's a side on the whole story. Yes, you can go ahead and do that. You can do that, We bring good news, right? So therefore, if you have some sort of, confidence, look, this is my home, and I can get a 20-year mortgage. I'm 30 years old. I can get a 20-year mortgage, and then where will the financing come from, right? So I'll come to that in a second. But also, please note, building a house in this country is so expensive because of all the para-tariffs and all the duties, right? Steel has so much para-tariff on it. The total tax on steel, I think, is about 103%. You have so much tax on tiles and sanitary ware and so on and so forth, right? People made billions. Some are even running for president, right? How did they make all this money, right? Because you put massive para-tariffs, huge duty walls, and then, you just mint money, right? And then what happens to the innocent 25-year, 30-year-old couple? They have no chance of building a house. So therefore, also note that we are looking at the other side of house building to be able for the young person, young family to afford a house. Now, I'm not going to talk about other infrastructure, roads, rail, things like that. Kabir also talked about that, we are in a bit of a situation because we signed the IMF agreement that we have to keep a primary surplus of 2.3%, right? Now, we'll take it as a blessing in disguise for this particular group. Why is it a blessing in disguise? Because what is a primary surplus? Primary surplus is revenue minus expenditure minus debt payments. You take out the capital payment anyway because that doesn't come in your, that's rollover, that's outside the budget, but on interest. So you take out interest, right? So therefore, what it means is it limits your expenditure on capital. So if you are going to build a road, you can't build that road anymore with public finance. Treasury is saying, no, sorry, no more building roads, no more building port, no more building airport with my money, because I got to meet this target of 2.3%. As a matter of fact, this year, they are meeting the expectation of the primary deficit has actually become a primary surplus. And as a matter of fact, the Treasury does not have a single OD with the Bank of Ceylon nor the People's Bank, which means that they are using that money to start paying off debt, right? That is what it is supposed to be. Now, from your perspective, or the perspective that we are sort of looking at, there is a huge opportunity. It is a huge opportunity for infrastructure financing, which didn't exist earlier because there was no sort of discipline on what kind of primary surpluses or primary deficits that you had to keep, right? So therefore, that opportunity arises. And yet another opportunity arises because we passed two bills. In fact, even as opposition, even as the elections are approaching, people think, look, opposition needs to oppose. No, opposition is not always expected to oppose. If there is something good, we don't need to oppose. So we didn't oppose the Public Debt Management Act. We didn't oppose the Public Finance Management Act. In fact, we supported that. Why? Because it brings discipline. So if we have discipline in public finance management, in public debt management, we will be able to actually have a much more confident, stable rate of growth. So how that becomes relevant in this discussion is with SOEs. Now, state-owned enterprises, let's forget for a moment about the cost-reflective pricing. Let's park that for the moment. Let's assume that will continue, right? Now, there is a whole other story about how to subsidize the folks who are unable to meet that cost-effective price. But this is not the forum to talk about that, but we'll deal with it separately, right? But on the other hand, what it means is the Treasury cannot, just like they did in the past all these years, just dole out money to the enterprise. Now you got limits. it's going to be very difficult. So the moment that happens, yet another door opens for long-term financing. Yet another door opens, right? So therefore, you're looking at multiple new opportunities that are getting created because of the discipline that we have on our own agreed to put on ourselves, and you know, the opportunities that arise from that. And you know, I'm not going to talk a lot, but also there are multiple opportunities exist in SMEs, whether it is, you know, agriculture or small hotels and things like that. Now let's get to the other side. So you got the capital deficit people, be it infrastructure, be it home housing loans, or be it state-owned enterprise, be it some other thing, right? Now let's look at where the long-term money is parked. Where is long-term money parked? Where is long-term money parked? Who's got the long-term money? Where is it? Well, it's pretty much with the EPF. I mean, all the trillions of long-term money is with the EPF. Now, where is the EPF money? 95% of EPF money is with the treasury. 5% is in the stock market. There's zero zilch in the long-term debt market. So then, what are we going to do about that? So you got the EPF, you got the ETF, the superannuation funds. Then you got life insurance. Where is the life insurance money? Right? Then you got these endowments and trusts and high net worth individuals and people like that. And also you have the foreign sort of portfolio investors, right? Now, how shall we utilize that money into matching demand that people have, be it home for building houses, building infrastructure, building power projects, building agriculture? How can we get that money here? So on the one hand, you know, reducing the money that the government requires for current expenditure. Correct? So if you are running a surplus in your current primary budget, then you are not borrowing for current expenditure. Immediately you have excess money. Immediately you have money that the government is not going to yank away from the market. Let's say 1% of GDP is $800 million, right? Isn't it? 1% of GDP is $800 million. So if you say, in a couple of years' time, if we say 1%, you create surplus in the primary account of 1%, that's $1 billion in rupees. Now, isn't that a sweet deal that will suddenly become available for you guys to create new instruments, you guys to start thinking about long-term financing of projects, be for public sector, private sector? Then also, do you think that the EPF, I'm asking you a question, right? Do you think the EPF should be a monopoly, right, in managing pension funds? Okay, there are small other pension funds, I know, right? Superannuation funds, small ones, but 90+% bulk is with the EPF. Do you think, I'm asking you a question, right? Do you think there has to be some competition in managing pension funds? How many people think yes? If you think yes, raise your hand. No, I can't see. No, raise. Okay. How many people think there shouldn't be competition in managing superannuation funds? Raise. Not a single. So what this means, Kabir, is this is like the gentleman said earlier, the largest gathering of the people in the market. So if the people in the market who know the market, not some bureaucrat somewhere, not some politician somewhere, think differently to politicians, then it better be that we take that advice. Personally, we think there should be competition in managing these funds. Now, there is a big issue about trust, about whether they'll take the money and run, right? So therefore, you have to have the right type of safeguards. But at the same time, you can theoretically think about, okay, how much is the EPF? 4 trillion? 4 trillion? Okay, it's 4 trillion. 1% of 4 trillion is what? 40 billion? 40 billion? Right. 400 billion? No, it's 4,000, no, 4,000 is 4 trillion. So 10% is 40, right? So 40 billion, that's just 1%. How about if we get 10% in competitive management? That's 400 billion. 400 billion. Now I'm just throwing some numbers around to sort of get a head around what kind of opportunities will arise, right, into the future. So if Honorable Sajid Premadasa as president is able to somehow work with all of you to think about a structure that money that is currently not in the market, because it is yanked away from the private sector to fund some useless government project, comes into you through your hands, through your investment strategies, through the debt market that we can create, we can actually create so much more growth, right? So that's really what it is. So I'm going to end now, but before I end, it's up to you. You guys are the stars here, not us. It's you who can come up with financial engineering. It is you who can come up with innovative instruments. It is you who can say, look, shall we create a derivative like this? I don't even know whether short selling happens in this market. Does short selling happen? I think the only sort of quasi-derivative is short selling, right? Does it happen? I'm asking the investment advisors, have you all done a short sale in the last 6 months? If you have, raise your hand. If you have, raise your hand. Nobody has short sold a single stock, Rajiv. No one has sold a single stock. So what kind of dynamics do you have? You just buy stock, sell stock. Is that it? Somebody puts something on the phone, this stock is going to go up, you buy that. That's not, come on, you guys are laughing. Has to be more than that, right? So you will be able to create these opportunities and fill those opportunities if the capital deficit can, through these instruments, match with capital surplus. So before I end, I want to make 2 points. Point number one is the IMF conditions. People said, could you please explain a little bit? What is SJB going to do? And as relevant to this, I will very quickly let you know that. And the second point is high quality regulatory structure. So I'll get to that first and then go to the IMF. So the thing is, we need strong independent regulator, right? Strong independent regulator. The strong independent regulator should not be interfered with by politicians. I mean, that is fundamental. You can't have a regulator that acts on the orders of some politician. That cannot happen. That will not happen. Because we've seen regulators in the past. I'm not referring to the current regulation. We've seen regulators in the past We've seen resignations, we've seen forcing out of regulators. So, regulator must be solid. Regulator must be independent. Regulator cannot be manipulated by politicians, right? So because, like Kabir said, not everyone is a crook, but there are unscrupulous characters in the market. There are fraudsters in the market, right? So the regulator must have a backbone to be able to catch these crooked fellows and deal with them. Now, just last week we heard the big story, right? X company, because of fraud that happened in 2011, which made the EPF lose 320 million rupees, was fined 320 million rupees 14 years later. How on earth is that justice? Is that justice? Didn't the money grow since 2011 to 2024? Was interest rate zero? Was inflation zero? 5 times. Somebody said 5 times. And do you think it is fair to compound it and whack 2.2 million per person for 3 people? I don't think so. But that is not the forum to discuss that. This is not the forum to discuss that. But we have to really think about this whole compounding business, right? And because if you're going to just get a slap on the wrist and you're said, go away, then how are you going to bring the right incentives for people to participate in the market? So I'm not going to talk about that anymore, but what I'm saying is regulator need not be very hard. Regulator can be soft. Regulator can be light touch, but the regulator must have a set of rules and you must stick within this set of rules. So, but we have to allow for dynamics in the market. The rules need not be so stringent that you can't innovate. You have to be able to innovate, right? And you can't put rule after rule after rule that restricts the activity of you guys. So we have to have a light touch regulator. But the light touch regulator has to fall within a set of rules and you have to follow it. And the last point is the reform of the IMF, which everybody talks about. We are not going to say, look, we are not going to be able to remove, change anything in the IMF agreement. That's nonsense, right? We have to amend the IMF agreement. But we will stay within the, I'm sure honorable leader of our party would, perhaps maybe explain, because he used only 2 words when we met, Peter Brewer, myself, Kabir, and Mr. Premadasa. He used only 2 words. Mr. Premadasa said to Mr. Brewer 2 words. 1, reform, 2, relief. We work within that. 1 reform, 2 relief. So, we know that we are in an agreement. We are not a bunch of jokers to say, we are going to change the whole agreement. We are not. We are serious players. We understand the repercussions of saying we will tear this up. We know that once we enter into the debt restructure, we have to abide by it. We are not going to say, we will pay it someday later, and they will say, okay. We are not a bunch of jokers, like I said earlier, right? So, we will play by the rules, right? We are not going to change the entire envelope. But we have to have the freedom internally to ensure that the reform is done with the right type of relief. So ask me the question, ask Kabir the question, ask Iran the question. Do we think 36% marginal tax is fair? The answer is no. We do not think 36% marginal tax kicking in at 308,000 rupees a month is fair. We don't think so. Now, can we change it? Well, as long as we can find other ways of increasing revenue, we can change it. Peter Brewer is not going to tell us, no, you can't. Who is he? Yes, we are going to work within the 15.8% of GDP tax to GDP, revenue to GDP. We're not going to change that. And we will say it in front of you people. We take responsibility for that. But within that 15.8%, we will certainly look at how we can bring in relief, we can bring in equity in taxes. Right? So that's just one. But the main sort of fundamental structural difference in the IMF program, we have said this to them from day one, is that there's a fundamental error, and that is that to them debt is debt and growth is growth. To us, that is not the case. Debt is external debt and domestic debt. Growth is tradable growth, meaning exports, and non-tradable growth. Right? What we have to have is tradable growth to pay our external debt. So where are you going to get tradable growth if tradable and non-tradable are both equally treated? So we want to tilt this economy slightly. We want to tilt it in such a way that we want to give the folks who need capital in tradable or export production a leg up. Right? We are clear with that. We want growth, but that growth must come from what we call tradables, which essentially means exports. Or it can even be internationally competitive import substitution, we don't care. Right? So within that structural shifting of the economic model, so that we can more than keep our debt sustainable, but actually achieve maybe 8 to 10% growth. So those are the types of changes, that amendments we want to make. So don't be fooled by those people who come and say, look, the opposition is saying they are going to change the IMF agreement. If they change the IMF agreement, there is going to be 72 hours of power cuts and 8 days in line for petrol. You know, we are responsible. We won't do things like that. But we will do what we have to do the reform with relief. And I hope I didn't waste I don't know how long I spoke, but I was told to give the keynote, so I took the liberty to speak at length. Thank you very much.